What's going on, guys? So in this video, I'm going to be going over my top 3 stocks to watch for December 2018, and all of these companies are companies that I either currently own shares of or companies that I am heavily considering purchasing, assuming, either certain news comes out or if, they say we're to go on a discount in the near future, I would be buying shares pretty much on the open market. So I just kind of want to be going through, kind of my methodology when I'm thinking about investing in these companies. And I also wanted to kind of go over my new investment strategy, for the foreseeable future over the next couple of years that I really plan on focusing on because of all the secular trends that are going on in the marketplace right now. And I just don't think, big cap tech stocks are going to be where the majority of the growth is, in the next couple of years. I think that kind of was behind us, and now we're kind of going into a different market environment. And so I'm going to be talking about that in a little bit briefly. So if you guys are interested in that, make sure to stick around and let's jump into the video. Oh, and before I do the video, I do want to say I'm sorry for, not being able to upload over the past week or so. I got very sick and I went to my parents' house. I was just in no position to really shoot any videos or anything. But now I'm back, I'm feeling better, and I should be able to regularly upload again like I was in the weeks prior to. So anyways, starting off, my new investment strategy is kind of my old investment strategy. So as you guys know, the past couple of years, I've been really focused on investing in tech because it was growing. It was kind of like the perfect storm. Interest rates were really low. Everybody was, piling on debt for their companies, and a lot of major corporations were doing massive expansion. And so a lot of people are switching to the cloud, and just a lot of semiconductor companies and other, big tech companies that I know pretty well from my job were, just reaping all the benefits of that. But now that's starting to slow down, as we see from the majority of their numbers. And, while some people are saying like, oh, well, it could just pick up again in a few months, I personally look at it as, well, I've made exponentially, I've made exponential returns over the past couple of years, with the majority of my stocks going up, over 100% in, 1 to 2 years time frame. I'm just, kind of walking away. I'm taking, my big winners, I'm cutting down on them. And then the ones that I have been investing in, the ones that I started positions not too long ago that I've recorded here, I still plan on keeping them, but I just don't think that that's where the majority of my new capital is going to be going in. And so, there's just a couple of things going on between their growth slowing, everybody kind of freaking out that, okay, we're due for a bear market, in which I don't really care too much about that because no one can obviously time when, the next bear market will come. But I do definitely see that growth is slowing in these companies, and now I'm going back to really focusing on high growth prospects in either small to mid cap companies or, forgotten industries or industries no one wants to be in. So this is mainly going back to my quote-unquote roots. When I first started investing, I pretty much only followed the teachings of Peter Lynch, from all of his books, and then, mixing it in a little bit with common stocks and uncommon profits and the intelligent investor. And I kind of just made a medley of different ways that I would invest in companies. And so that's kind of what I'm going to be focusing on right now, because I definitely think that excluding the perfect storm that, tech stocks went through the past couple of years, I think this is the best investment strategy for me. I can handle the volatility, but when everybody starts talking about semiconductor stocks and they don't even know what a CPU is, let alone what a capacitor is or how the actual thing's made, I just don't want to be a part of it right now until, all of the speculators are really out of the space. And I think the easy money is over, so I'm just walking away while I'm up. And that's kind of what's going on. So these 3 companies are going to be focused on this investment strategy that I'm talking about. So first off is National Beverage Corporation. Now, this is a company that has had really good prospects over the past couple of years. It's the company that makes the LaCroix sparkling water. I don't know if any of you that are in America, I'm sure you've at least seen some people drinking this over the past couple of years. A lot of millennials are focusing on, healthier alternatives. They're kind of veering away from soda consumption. And as you've seen that since the late 90s, soda consumption has been on a downwards trend. And companies are just, focusing on the healthier alternatives. And this relatively small company kind of hit it home over the past couple of years. So this company was pretty much, they make their standard, I would say, knockoff beverages. Like, they make knockoff teas and sodas and energy drinks and everything that you'll see at, that, discounted store, Family Dollar-esque retail environment. And so, obviously, no one was really going out and seeking their beverages until they made the LaCroix acquisition and really focused on branding LaCroix. And so, thankfully, a lot of people are focusing on, water and seltzer water and sparkling water. And everything just kind of made LaCroix seem like the premium product for this category. But over the past couple of years, they've had EPS growth of north of 25% per year over the past 5 years. In the last 3 years, it's been over 28%. So they're growing, and they're growing faster and faster, which is something good. The company has no debt on their balance sheet. So if you look at their balance sheet, they actually have, compared to the other non-alcoholic beverage manufacturers, they are pretty impressive with, the valuations that they're trading at and the amount of growth that they're going through. In my opinion, they're trading at, I would say a fair discount. They're definitely not overvalued, but they're definitely not why is this company, a third of what its value should be. I do think they're trading on the discounted side, but for this amount of growth and having lower than average ratios, that's something I'm very interested in. I will also say that another really interesting thing with this company is it also has the ability to be a buyout, acquisition in the future. And my skeptical hypothesis, let's say, for that is because if you look at PepsiCo, they bought the company SodaStream when they were, revamping their bubbly because they saw that, okay, a lot of millennials and a lot of Gen Z are really focusing on this type of market and they want to jump on that niche. So they made the bubbly brand. They bought out SodaStream. That when they bought out SodaStream, mind you, SodaStream was trading for higher multiples than what National Beverage Corporation is trading for currently, ticker symbol FIZZ. And so that kind of piques my interest because now Coca-Cola isn't really, as up to date on this trend as Pepsi is now. So if Coca-Cola wants to kind of get into this space, I think National Beverage Corp is probably their easiest acquisition to really get a foothold in this whole demographic and this growing niche that is projected to grow at a much faster rate than soda over the next, couple of years. So that's an interesting, prospect, for a future. And then another thing is that the share price right now is artificially suppressed, in my opinion, because there was a news article that came out a few weeks ago that this company was using non-natural ingredients in their their manufacturing process. And when I looked at what the allegations were and what the company said, and then what people that I know of that are biochemists looked at the allegations because I had them look at it for me, it's kind of just BS. There's no realistic reason why they could say the ingredients that they were talking about or the chemicals that were used in, say, the manufacturing process are in fact natural. And so the legality or even the scientific grounds that are based around this lawsuit, I don't think have any merit. It'll be interesting to see how that plays out. This is I looked into the law firm a little bit, didn't spend too much time in it, and it's a small law firm in Missouri, I believe. And I think that this just had a client that was just kind of throwing a dart at a dartboard and was like, yeah, we can sue this person, see if we can make some money. But I personally don't think there's any ground for it, so I think it's just artificially suppressed. And I think that will bog down their sales for maybe this quarter because a lot of companies are kind of stopped advertising them heavily until this all subsides. So I think that this will definitely, push them down for the short term because it's a small company. It doesn't have a lot of, customer brand loyalty other than the past couple of years. So I definitely think that once that kind of subsides, they'll just be able to manufacture and just kind of pump out their branding again. And I think other companies will really push their products again because they were selling really well and they were the fastest growing sparkling water over the past couple of years. So it will even kind of, it might even draw attention to, say, like Pepsi with their bubbly line and things like that. So that's a couple of things. I can do a more in-depth video on them if you want, but that's a lot of things I highly recommend checking out. The company. They have a really good growth rate. They have a special dividend that they've done. This isn't the first time they've done a special dividend, but now currently the special dividend will be from current pricing is about a 3% yield that they'll be paying out in a month. So it's pretty interesting. A lot of interesting things going on with this company. It's a little bit under $5 billion of market cap. And so I definitely think it's worth keeping an eye on, in the years to come. Next company is Altria, so ticker symbol MO. So obviously, this is a cigarette company. They own wines. They own 10% of Anheuser-Busch. This company obviously is not, for the I'll say the average investor. Not many people want to be, say that, oh, I own shares of a tobacco company. As we all know, tobacco is extremely unhealthy, and it's, probably one of the worst vices that the majority of Americans have. But I will say, from an investment standpoint, it looks pretty attractive. So you guys know that I've been investing in tobacco, and so this is one of the companies that I currently have a position in. And I don't know. So as you guys talked, British American Tobacco was in my stocks for November, and the whole tobacco space since that came out has been hammered, and it's made it very more, intriguing for position in all these. And so while I definitely think of the two big tobacco players as being, BTI and Altria, I definitely think Altria is the safer absolute return, and the British American Tobacco is more of the higher risk, high reward based off of, book value and their current dividend yields and things like that. But if you, say, wanted to, get a pretty good, stalwart type of investment and, just have, steady investments and cash flow coming out over the years, I definitely think Altria is in a prime position right now to start your position. Definitely wouldn't say go lump sum right now, because the tobacco industry is in a bear market. No one wants to be in it. There are a lot of FDA things going on right now that are suppressing the entire sector that I personally think is getting overreacted, and I'll get into that in a little bit. But from a valuation standpoint, Altria is trading at a discount compared to what it normally does. So right now its PE is under 14, its dividend yield is about a 6, and it's had almost 50 years of constant growth. So that is something that you don't really have to worry about, in my opinion, for the short term. Or even for the long term, going ahead, if you just want to focus on Altria as a cash flow position. They own 10% of Bud, so Bud did just cut their dividend, but they own 10% of one of the largest breweries in the world, and they get, their dividends. I think their dividend's now like 2.5%, something like that. It was just recently cut. But they still get a lot of passive cash flow, and that inherently will diversify the company. Say if cigarette issues, come around, if alcohol does really well for a year, Altria will still be making money off of that. They do also own a couple of wine companies, but that is really interesting to, have instant, diversification within the, the tobacco and alcohol space just by owning Altria alone. Marlboro does also have a 40% market share of U.S. cigarettes. And so getting into the FDA issue, the FDA that made the whole tobacco industry kind of freak out was that the FDA brought up, because the Juul epidemic and a lot of young people switching onto tobacco, and then the majority of those people were then switching onto cigarettes. They were thinking about, banning flavors in, gas stations and non-21 plus stores, and then also menthol. And so that's why British American Tobacco took a major hit, because half of their U.S. revenue is from menthol-based cigarettes with Newports. And Marlboro does get about 20% of their of the Marlboro line comes from menthol-based cigarettes. But when I read I went onto the FDA's site and I read exactly what the proposition was. I think it's a little bit of a skewed reaction, and that's because it's not a flat-out ban of menthol cigarettes, is what everybody was talking about. Actually, menthol and mint-flavored cigarettes were getting significantly less, focus in this in this proposition than, say, like the flavored, the mango-flavored Juul pods and things like that are the cause of this concern. They said that they were going to restrict the sales in, say, stores that people under the age of 21 could get into. So that essentially, will alienate, your gas stations and, your pharmacies and things like that. But it doesn't alienate, smoke shops and tobacco shops and things that are, you're going to still be able to buy these products. You just can't buy them, when you're going to get gas. And the way I look at that is, well, okay, so cigarettes, as we all know, isn't something that, okay, my favorite brand gets discontinued, I'm just going to stop on the dime. That isn't realistically, going to happen, in my opinion. And I also don't think that, if you're, say, someone that smokes Newports, or if you smoke, menthol Camels, whatever, if you find your brand of cigarettes that you really like, I think the average person that, like that won't matter. They're not going to care if, okay, I can't go to the gas station to buy them. I have to now go to a liquor store, or I have to go to a smoke shop to go and buy them, because odds are in their town they have either a liquor store or a smoke shop that'll sell them. And if they don't now, those shops will probably open up, a stand for it, because they're going to get a lot of, customers coming in for it. So I don't think that, everybody's pricing in as if they're going to just lose that revenue. I don't think even if there was a full-on ban with menthol that they would lose that revenue. I think they just switched to non-menthol cigarettes before they quit smoking. That's the harsh reality of the world. And two, I still don't think they really have to worry that much about it. So the tobacco space is one that, compared to other spaces right now, as investors like Peter Lynch and Warren Buffett would look into, unattractive industries trading at a discount compared to the overall market. I definitely think tobacco is one of those industries, and I think Altria is probably the safest risk-reward type of investment in the space, if you guys want. I know one subscriber already asked for me to do a full Altria in-depth analysis, and I will be doing that soon. If you guys want me to do any of the other tobacco stocks, make sure to let me know in the comment section down below. But So second stock is Altria, and Altria I am just adding into my position slowly because I do not think that this will be making money in the short term, but I could see 5-10 years from now Altria being a huge, return on investment type of investment. And the last company is one that is the smallest of the bunch, and it's something that I'm imagining most of you, if you've ever been to a shopping mall in America, have seen, and that is American Eagle Outfitters. So this company is kind of an interesting play for me. So I worked in retail throughout high school and a little bit in college. So I've worked in the retail space for about 6 years, off and on through seasonal, full-time, part-time, things like that. And at every mall I've worked at, there's been American Eagle, and every American Eagle, through every Black Friday, always gets packed. And so I actually, right before I made an investment in American Eagle, because I made it on Black Friday this year, a small position to start, I went to 2 really popular malls, and both of them, the most packed apparel store in the whole mall that I could see is American Eagle. And I believe that is mainly because of their Aerie line and them really focusing on, selling the panties and everything, and a lot of people inherently in that space not shopping at Victoria's Secrets. So if you guys have paid attention to the retail space, you've seen L brands get hammered the past couple of years just because Victoria's Secrets isn't growing. And pretty much all of that growth is going directly to American Eagle, at least from my perspective. So the company is definitely, it's a popular brand that I haven't really seen lose attractiveness over the past 7 years or so. Just when I've been observing it when I was in high school, everybody wore American Eagle. I obviously don't hang out at high schools anymore, but I still think that that's a relatively popular brand amongst youth, and that is kind of what decides who, makes it or breaks it in the retail space. But so looking at, just what's going on with them currently from a number standpoint, so comps and across the board have been up 7%, and that's mainly due to their Aerie year-over-year growth. They have no debt on their balance sheet. They have a really, really strong balance sheet and relatively very low ratios in the apparel space. They have no debt, which is something that I'm extremely focused on. That's probably my biggest pet peeve, is having too much debt that the company can't handle. And with American Eagle having no debt, they've been around for, I think, 40-something years. They pay a 2.8% dividend right now, which is, it's not like an amazing grab, but it's definitely something that I like seeing, especially in this volatile market, just getting some basic return that I can throw on to my risk analysis. Online sales have been about 27% of their comps. So this company is one of the few companies in the retail space that, is handling relatively well with the whole Amazon meltdown infrastructure, just Amazon taking out all these small mom and pop shops. American Eagle has definitely capitalized on it. Their app's very user-friendly, and they have not missed a beat as far as getting those sales out there, through email deals and things like that. I should also notice that while comp sales, overall, were up 7%, their Aerie line was up 24 to 27% over the past couple of years. So that line is exploding, and I definitely think that that's going to be their future growth driver, especially with companies like L Brand really messing up and not capitalizing on consumer trends and things like that. American Eagle also just did a new line where it was don't change you, change your bra marketing ploy, and I think it's been very effective, obviously, in their numbers, but it's more focusing on, everybody has their own individual body shape. You don't have to be, say, a Victoria's Secret model, and you don't need that atypical body type. And I think that resonates very well with, say, millennials and women in younger generations. I think that that's more of a focus of society than it was, say, 10 years ago when everybody was like, you need to look like a Victoria's Secret model. So I definitely think American Eagle is, approaching it well. They're executing well on all cylinders. Management's been pretty straightforward. They've been growing really well compared to the overall retail space that's been hammered, and they've just come down to a relatively attractive price. I did own them a while ago, sold out, and then they ran up another 20-30% from when I sold out. So thankfully they're back down to a level where I can say okay, now is a good chance to start accumulating shares. Again, they popped off after Black Friday, so I imagine there were some people who had, went around the mall and saw the sales that I saw. Obviously, that could just be speculation, but it was interesting to see the retail space on Black Friday at market open and at market close, what was going on with them. But I definitely think American Eagle is going to be one of the best plays, for this holiday season and possibly for the next couple as well. So I would definitely say keep them on your watch list, especially if you're looking for, non-tech stuff and you're trying to diversify your portfolio like I am. I think retail is a relatively simple, space to look into. I will say that I'm going to pull right from Peter Lynch here and say that when you're analyzing a retail company, you really want to analyze the most important thing, at least for this space, assuming they have a good balance sheet, I definitely think is how fast their sales are growing and how fast their inventory is growing. Thankfully, American Eagle is not growing inventory faster than sales. So that means that, say, if they're not like on the cusp of trends, they don't get stuck eating a lot of inventory and taking a discount on it, because that's something you really got to look at when you look at their balance sheets, is that their inventory, very well could only be worth like 50% of what they're writing down on their balance sheet. So that's something you definitely need to keep in mind. That's something that American Eagle was one of the very few retailers that I felt that satisfied all of the criteria that Peter Lynch outlines when he talked about investing in retail stocks. And I think they're trendy. I think they're, well run, and I think they have financial stability. So all in all, I really like the company, and I definitely think they're worth taking a look into. So that's it for my 3 picks. I hope you guys got some use out of that. Let me know what you guys are looking at for December. Let me know what stocks you're interested in buying, and we'll make sure to do individual stock analysis soon, because I know a lot of you are asking for that. So thank you guys for watching. Hope you guys enjoyed the video, and I will catch you in the next one. Peace.